Listen carefully: JPMorgan, Citibank, and every Western bank extracting billions from African deposits while denying us credit. 5 minutes ago, I launched Africa's largest black-owned banking network, 87 banks across 54 African countries with $340 billion capitalization, terminating your 65 years financial monopoly. You believed we'd deposit wealth in your vaults forever while you charged us 14% interest on our own money. You were dead wrong. I built this with African capital and Chinese technology. I'm moving $840 billion from your banks to ours. You're finished. Let me tell you exactly what happened. On December 10th, 2025, I stood at the African Union Financial Summit with heads of state from 54 African nations and signed the Pan-African Banking Charter, the founding document establishing the Alliance of African Prosperity Banks, a network of 54 black-owned, African-controlled financial institutions designed to replace Western banking monopolies that have extracted an estimated $2.8 trillion from African economies since 1960. The signing ceremony took 11 minutes. In those 11 minutes, we created the largest banking network ever established in the developing world, capitalized with $340 billion in combined equity from African governments, sovereign wealth funds, central banks, and private African investors. We didn't ask for World Bank approval. We didn't consult the International Monetary Fund. We didn't seek permission from Western financial regulators. We announced it, signed it, and activated it, and by 5:09 p.m. that same day, the first 34 banks were operational and accepting deposits. The Western financial media called it impossible. Bloomberg published an article titled "African Banking Experiment Faces Insurmountable Structural Challenges." The Financial Times ran an editorial claiming insufficient capital and expertise doom Pan-African banking initiative. The Wall Street Journal quoted anonymous JPMorgan executives saying, "African governments lack the financial sophistication to operate modern banks." They were completely wrong, and they knew they were wrong because their criticism wasn't based on analysis, it was based on fear. Western banks have controlled African finance for 65 years, extracting hundreds of billions in profits by holding African deposits and lending them back to Africans at interest rates 400% to 700% higher than they charge Western borrowers. That extraction machine just broke, and they're terrified. Listen carefully to how Western banking colonization actually worked in Africa, because unless you understand the theft mechanism, you can't appreciate why what we built destroys it permanently. Western banks entered Africa during the colonial period: Barclays in the 1920s, Standard Chartered in the 1860s, Societe Generale in the 1880s, not to serve African economic development, but to facilitate resource extraction to Europe. These banks financed European trading companies buying African commodities, processed payments for colonial administrations, and held deposits for European settlers and businesses. When African nations gained independence in the 1960s, these Western banks didn't leave, they adapted. They rebranded as international banks serving African development and positioned themselves as essential infrastructure African nations supposedly lacked capacity to build independently. African governments, led by Western-educated elites who believed European banking superiority was natural law, welcomed them. That was our first mistake. Here's how the extraction worked. Western banks operating in Africa, JPMorgan Chase, Citibank, Standard Chartered, Barclays, HSBC, BNP Paribas, Societe Generale, and others, collected deposits from African governments, businesses, and individuals, paying interest rates averaging 1.2% annually from 2000 to 2025. They then lent those same deposits back to African borrowers at interest rates averaging 14.8% for corporate loans and 22.4% for consumer loans over the same period. The spread, the difference between what they paid depositors and what they charged borrowers, averaged 13.6% for corporate lending and 21.2% for consumer lending. That spread is pure profit extracted from African economies. In the United States, the equivalent spread averages 3.2% for corporate loans and 6.8% for consumer loans. In Europe, it averages 2.8% and 5.4%. Western banks charged Africans 4 to 5 times the spreads they charged their own citizens for identical banking services. Why? Because they could. African borrowers had no alternatives. Local African banks were tiny, undercapitalized, and couldn't compete with Western banks' resources. So Africans deposited money in Western banks at 1.2% and borrowed it back at 14.8%, enriching Western shareholders with the 13.6% difference. Let me show you the scale of this theft with specific numbers. As of December 31st, 2025, Western banks operating in Africa held approximately $1.2 trillion in total deposits from African sources, governments, businesses, and individuals. On those deposits, they paid average interest of 1.2%, totaling $14.4 billion annually. Those same banks extended approximately $680 billion in loans to African borrowers, charging average interest of 16.8% across all loan categories, generating $114.2 billion in annual interest income. The difference, $99.8 billion annually, represents gross interest profit extracted from African economies by Western banks every single year. But the extraction doesn't stop there, because Western banks also charged fees. Account maintenance fees, transaction fees, wire transfer fees, foreign exchange fees, loan origination fees, early repayment penalties. These fees totaled an additional $28.4 billion annually across African operations. Combine interest spreads and fees, and Western banks extracted $128.2 billion annually from African economies. Over the 24 years from 2000 to 2025, that totals $3.08 trillion in cumulative extraction, more than the entire GDP of France transferred from poor African nations to wealthy Western bank shareholders. But even those staggering numbers understate the real damage, because Western banks didn't just extract wealth through interest spreads and fees, they also controlled credit allocation in ways that deliberately suppressed African economic development. Western banks operating in Africa prioritized lending to three sectors: foreign corporations extracting African resources, import-dependent businesses buying European and American goods, and African governments borrowing for consumption rather than productive investment. Meanwhile, they systematically denied credit to the sectors that drive genuine development: small and medium manufacturing enterprises, agricultural processors adding value to raw materials, technology startups, and infrastructure developers. Why? Because Western banks profited from Africa remaining a raw material exporter and finished goods importer. If African manufacturers received credit to build factories processing cocoa into chocolate, African cocoa farmers would capture value currently extracted by European chocolate companies, which would reduce demand for European imports, which would reduce the foreign exchange flows Western banks profited from processing. Western banking in Africa wasn't designed to develop African economies. It was designed to keep African economies in permanent subordination to Western economic interests. I'll give you a concrete example from Burkina Faso. In 2018, a Burkinabe entrepreneur named Amadou Sanfo approached Société Générale in Ouagadougou seeking a $2.4 million loan to build a shea butter processing facility. Burkina Faso produces 120,000 tons of raw shea nuts annually, which we export to France, Britain, and the United States for $180 million, where they're processed into shea butter worth $840 million in cosmetics markets. Sanfo's plan was to process shea nuts domestically, capture the value-added processing margin, create 240 jobs, and export finished shea butter instead of raw nuts. His business plan showed 18-month payback period and 34% annual returns. Société Générale rejected the loan, citing insufficient collateral and untested market assumptions. 3 months later, the same bank approved a $2.8 million loan to a French-owned import company bringing European cosmetics, including shea butter products made from Burkinabe raw materials, into Burkina Faso for retail sale. They refused to finance African value addition but enthusiastically financed European imports made from African resources. That's not banking, that's economic colonization with spreadsheets. That example multiplied across thousands of rejected African entrepreneurs and billions in denied productive credit explains why African economies remain dependent on exporting raw materials and importing finished goods for 60 years after independence. It wasn't lack of African entrepreneurship, it was systematic denial of credit by Western banks controlling African finance, and this brings me to why we built the Alliance of African Prosperity Banks, to replace Western banks that serve Western interests with African banks that serve African development. The idea originated on March 22, 2025, during an Alliance of Sahel States Economic Summit in Niamey, Niger. I was meeting with President Assimi Goïta of Mali and General Abdourahmane Chiani of Niger, discussing how to finance the infrastructure projects we'd planned: railways, solar farms, food security programs. We'd already secured Chinese financing for construction, but we needed banking infrastructure to process transactions, manage payroll for hundreds of thousands of workers, provide trade finance for cross-border commerce, and extend credit to African businesses supplying our projects. The existing options were Western banks charging extortionate rates and imposing political conditions, or tiny local African banks that lacked capacity to handle billion-dollar projects. Neither option served our interests. President Guaida said something I'll never forget. We expelled French troops, we're building our own currency, we're nationalizing our resources, but we're still depositing our money in French banks, who lend it back to us at 14% interest. We're financing our own colonization. He was absolutely right. That night, I ordered Burkina Faso's finance ministry to conduct a comprehensive audit of the Burkinabe banking sector, specifically analyzing capital flows between African depositors and Western banks. The audit, completed on May 8, 2025, revealed exactly what I suspected. Western banks operating in Burkina Faso held $4.2 billion in deposits from Burkinabe sources, but extended only $1.8 billion in loans to Burkinabe borrowers. The remaining $2.4 billion in deposits was transferred out of Burkina Faso to parent banks in Paris, London, and New York, where it was lent to European and American borrowers or invested in European and American assets. Burkina Faso depositors earned 1.2% interest on that $2.4 billion, $28.8 million annually, while Western banks earned average returns of 7.4%, lending those deposits in Western markets $177.6 million annually. The difference, $148.8 million annually, represented wealth extracted from Burkina Faso's economy simply because we didn't control our own banking system. Multiply that across 54 African nations, and you understand why Africa has $1.2 trillion in deposits but remains capital-starved. Western banks collect African deposits and invest them in Western economies, leaving Africa perpetually short of credit. I shared that audit with 41 African heads of state via secure diplomatic channels between May 15, 2025 and June 10, 2025. I asked each leader to conduct equivalent audits in their countries. By July 30, 2025, I'd received 28 audit reports, all showing identical patterns. Western banks collected massive African deposits, lent only a fraction back to African borrowers at extortionate rates, and transferred the majority to Western markets for investment. The audits collectively documented $680 billion in African deposits transferred annually to Western financial markets, $680 billion that should have been financing African development, but instead financed European mortgages, American corporate expansions, and Western government bonds. That's when we knew we had to act. On August 18, 2025, I convened a secret meeting in Kigali, Rwanda, with 34 African finance ministers and central bank governors. I presented a proposal: create a pan-African banking network capitalized with $340 billion from African governments and sovereign investors, designed to replace Western banks across all major African markets within 36 months. The network would consist of 87 banks, 2 or 3 in each participating country, owned jointly by African governments and African private investors, managed by African bankers, utilizing Chinese banking technology and digital infrastructure, and operating under a unified Pan-African banking charter that prioritized African development over shareholder profit maximization. The banks would offer identical services to Western banks: deposits, loans, trade finance, foreign exchange, digital payments, but with fundamentally different economics. Paying depositors 4.2% interest instead of 1.2%, charging borrowers 7.8% interest instead of 14.8%, and dedicating 60% of loan portfolios to productive sectors, manufacturing, agriculture processing, technology, and infrastructure, that Western banks systematically denied credit. The finance ministers asked the obvious question: where would we get $340 billion in startup capital? I told them, we already have it. African governments collectively held $480 billion in foreign reserves as of June 2025, with $420 billion deposited in Western banks earning 0.8% to 1.4% interest. I proposed redirecting $240 billion of those reserves, 50% of the total, from Western banks into the new African banking network as founding capital. Additionally, African sovereign wealth funds, including Nigeria's $18 billion fund, Angola's $9 billion fund, Botswana's $7 billion fund, and 12 others, would contribute $60 billion. African central banks would contribute $25 billion, and African private investors, wealthy individuals and businesses who'd accumulated capital despite Western extraction, would contribute $15 billion. Total capitalization: $340 billion, making the Alliance of African Prosperity Banks the 12th largest banking network in the world by capital upon launch, larger than many European national banking systems. The second question was technology infrastructure. Could African banks match Western banks' digital capabilities, mobile banking platforms, and payment processing systems? I told them, we're not matching Western technology, we're leapfrogging it with Chinese systems. China's banking technology is the most advanced in the world. As of 2025, China had 950 million active digital banking users, processed 240 billion mobile payment transactions worth $52 trillion annually, and operated banks like WeBank and MyBank that existed entirely digitally with zero physical branches. Chinese banks develop sophisticated AI-driven credit scoring, blockchain-based settlement systems, and quantum encryption for security, all superior to Western banking technology built on legacy systems from the 1980s and 1990s. I'd already negotiated with China Construction Bank, Industrial and Commercial Bank of China, and Ant Group to provide complete technology transfer, core banking software, mobile apps, payment processing infrastructure, AI credit assessment tools, and cybersecurity systems for $8.4 billion, a fraction of what it would cost to build independently or license from Western providers. With Chinese technology, our banks would launch with more advanced capabilities than JPMorgan or Citibank operating in Africa. The third question was expertise. Did Africa have enough qualified bankers to staff 87 banks? I told them, yes, because we're bringing them home. Approximately 34,000 African banking professionals worked in Western financial centers as of 2025. London's financial district employed 8,400 Africans. New York's Wall Street employed 6,200. Paris employed 4,800. Frankfurt employed 2,100. These were Africans trained at top universities with experience at JPMorgan, Goldman Sachs, Citibank, Deutsche Bank, and other major institutions who left Africa because Western banks paid higher salaries and offered better career advancement than tiny local African banks. I proposed recruiting 4,200 of these diaspora banking professionals, offering salaries matching their Western compensation, leadership positions running our new banks, and the opportunity to build African financial systems instead of enriching Western shareholders. By August 30, 2025, my team had identified 6,800 qualified African banking professionals in Western financial centers and begun confidential recruitment. By October 15, 2025, we'd secured commitments from 4,780 professionals, more than we needed, to return home and lead the new banks. The expertise existed, it just needed to come home. On November 8, 2025, the 34 finance ministers returned to their capitals and presented the proposal to their heads of state. By December 3, 2025, 54 African nations formally committed to participate: Burkina Faso, Mali, Niger, Senegal, Ghana, Nigeria, Kenya, Tanzania, Uganda, Rwanda, South Africa, Angola, Zambia, Zimbabwe, Ethiopia, Egypt, Morocco, Algeria, Tunisia, Côte d'Ivoire, Benin, Togo, Guinea, Chad, Cameroon, Gabon, Democratic Republic of Congo, Botswana, Namibia, Mozambique, Madagascar, Mauritius, Sudan, South Sudan, Somalia, Djibouti, Mauritania, Liberia, Sierra Leone, Guinea-Bissau, and Eritrea. Only 12 African nations declined to participate, mostly small island nations or countries with unique circumstances. The 42 participating nations represented 94% of Africa's population, 96% of Africa's GDP, and 97% of Africa's banking deposits. We had the coalition we needed. From December 3, 2025 to March 15, 2025, we executed the planning phase, drafting the Pan-African Banking Charter, establishing legal entities for 87 banks, negotiating technology transfer agreements with Chinese partners, recruiting management teams, designing branch networks, and preparing regulatory frameworks. Each participating country would host 2 or 3 banks depending on population and economic size. Nigeria would get 6 banks, South Africa would get 5, Egypt would get 4, Kenya would get 3, and so on. Each bank would be capitalized with $2.8 billion to $5.4 billion depending on market size, with ownership split 60% government and 40% private African investors. The banks would operate independently under local management but share technology infrastructure, liquidity support systems, and strategic coordination through an alliance of African Prosperity Banks Council headquartered in Accra, Ghana. The charter required all member banks to dedicate minimum 60% of loan portfolios to productive sectors, cap interest rate spreads at 5% between deposits and loans, maintain capital adequacy ratios of 18%, significantly higher than international minimums, and reject any political conditions on lending from external actors including Western governments and international financial institutions. From March 15, 2025 to June 30, 2025, we executed the construction phase, building physical infrastructure while simultaneously developing digital platforms. We established 2,140 physical bank branches across 42 countries, an average of 34 branches per bank, located strategically in capital cities, major commercial centers, and underserved rural areas where Western banks never operated because they weren't profitable enough. We installed 48,000 ATMs manufactured by Chinese ATM producer GRG Banking, compared to only 14,000 ATMs operated by all Western banks in Africa combined. We deployed 340,000 point-of-sale terminals for merchant payments. And we built the digital infrastructure, mobile banking apps compatible with every smartphone operating system, USSD banking for basic phones without internet access, agency banking networks using retail shops as banking access points in areas without branches, and blockchain-based interbank settlement systems enabling instant cross-border transfers between member banks. The entire build-out cost $18.4 billion, $8.4 billion for Chinese technology, $6.2 billion for physical infrastructure, $3.8 billion for initial working capital, financed through founding capital contributions. We built 87 banks in 15 months. From June 30th, 2025 to September 20th, 2025, we executed the recruitment and training phase. We onboarded 4,680 diaspora banking professionals returning from Western financial centers to lead our banks as CEOs, chief risk officers, heads of credit, heads of operations, and senior managers. We recruited 28,400 African banking professionals working in Western banks' African subsidiaries, offering them 40% salary increases and ownership stakes to switch employers. We hired 67,000 new employees, tellers, customer service representatives, loan officers, IT staff, security personnel, creating 67,000 jobs across 42 countries. We conducted intensive training on Chinese banking technology systems, Pan-African banking charter requirements, and credit assessment methodologies prioritizing productive lending. By September 20th, 2025, we had 160 employees fully trained and ready across 87 banks, the largest banking workforce deployment in African history. On September 28, 2025, we conducted final systems testing, processing simulated transactions, stress testing cybersecurity, validating interbank settlement, and confirming regulatory compliance across all jurisdictions. Every system performed flawlessly. On October 8, 2025, we received final regulatory approvals from 42 national banking authorities, all of which we controlled through government participation. On October 18, 2025, we executed the capital transfer. $340 billion moved from African government reserves, sovereign wealth funds, central banks, and private investors into the 87 banks' accounts, the largest single-day capital movement in African financial history. On November 4, 2025, we began the soft launch, opening accounts for government ministries, state-owned enterprises, and select corporate clients to validate operations under real conditions with limited volume. Between November 4, 2025 and December 9, 2025, the 87 banks opened 184,000 accounts, processed $28.4 billion in transactions, extended $8.7 billion in initial loans, and operated with zero significant technical failures. The soft launch proved the system worked. Then came December 10, 2025, the public launch. At 2:00 p.m., I signed the Pan-African Banking Charter at the African Union Financial Summit in Accra. At 2:30 p.m., all 42 heads of state signed as witnesses. At 3:00 p.m., the 87 bank CEOs held simultaneous press conferences in their capitals announcing their banks were open for business. At 3:30 p.m., branches opened to the public across 54 African. At 4:00 p.m., mobile banking apps activated for download. At 5:00 p.m., the first customer deposits began flowing in. The manufacturing credit surge will create 8.4 million new manufacturing jobs across Africa by 2027, increasing manufacturing employment from 24 million in 2024 to 32.4 million in 2027, a 35% increase in 3 years. Those 8.4 million jobs will predominantly benefit young Africans aged 18 to 35, who currently face 42% unemployment rates in urban areas, providing productive employment, skills development, and income stability that transforms lives and stabilizes societies. Manufacturing wages in Africa average $420 monthly as of 2024, 3 times agricultural wages of $140 monthly, and double informal sector wages of $210 monthly, meaning manufacturing job creation directly lifts families out of poverty while creating middle-class consumer demand, driving further economic growth. The 8.4 million new manufacturing workers earning average $420 monthly will inject $42 billion in new annual purchasing power into African economies, creating demand for housing, consumer goods, transportation, entertainment, and services that generates additional employment across all sectors. Manufacturing credit will also drive import substitution, reducing Africa's $580 billion annual import bill that drains foreign exchange reserves and perpetuates trade deficits. As of 2024, Africa imported $184 billion in manufactured consumer goods, clothing, electronics, household items, processed foods, that African manufacturers could produce domestically if they accessed credit for factory construction and equipment purchases. Alliance Bank Manufacturing Lending will finance domestic production, substituting for $94 billion in current imports by 2027, cutting the manufactured goods import bill from $184 billion to $90 billion, and saving $94 billion annually in foreign exchange that can be redirected to importing capital equipment and technology for further industrial development. Import substitution will also create multiplier effects throughout African economies because domestically produced goods generate supply chain demand for African raw materials, African packaging, African logistics, and African retail, capturing value addition at every stage that imports send overseas. Agricultural processing credit will transform African agriculture from raw commodity export orientation to value-added processing, generating higher revenues and employment. As of 2024, Africa exported $89 billion in raw agricultural commodities, cocoa beans, coffee beans, cotton, cashews, sesame, livestock, fish, earning minimal revenues while importing $67 billion in processed food products derived partially from African raw materials exported and processed elsewhere. This value capture failure cost Africa an estimated $118 billion annually, the difference between revenues from raw exports versus what processed exports would generate. With $168 billion in agricultural processing credit from alliance banks by 2027, another third of productive lending, African farmers and cooperatives will build processing facilities capturing value addition currently lost to foreign processors. Ghana currently exports $2.8 billion in raw cocoa beans annually to European chocolate manufacturers who process them into $28 billion in finished chocolate products. Ghana captures 10% of value, while Europe captures 90%. Alliance Bank of Ghana Manufacturing and Agricultural Credit will finance Ghanaian chocolate factories processing domestic cocoa into finished chocolate for export and domestic consumption, increasing Ghana's cocoa value capture from $2.8 billion to projected $8.4 billion annually by 2028, tripling revenues from the same crop volume simply by processing domestically instead of exporting raw. Côte d'Ivoire, producing even more cocoa than Ghana, will experience similar transformation. Kenya exports $1.2 billion in raw coffee beans, while importing $340 million in processed coffee. Alliance Bank of Kenya Agricultural Credit will finance coffee roasting and packaging facilities, enabling Kenya to export processed coffee at triple the raw bean prices while substituting for imported processed coffee. Ethiopia, Tanzania, and Uganda will replicate this model across their coffee sectors. Cashew processing illustrates agricultural credit's transformative potential perfectly. Africa produces 57% of global raw cashew nuts, 3.2 million tons annually, but processes only 14% domestically, exporting 86% as raw nuts to India and Vietnam for processing into cashew kernels worth 4 times raw nut prices. This value capture failure costs Africa $4.8 billion annually. Alliance banks will finance cashew processing facilities across Benin, Burkina Faso, Côte d'Ivoire, Guinea-Bissau, Mozambique, and Tanzania, the major cashew producers, enabling domestic processing of 80% of cashew production by 2028 instead of exporting raw. This processing shift will increase African cashew revenues from $2.4 billion currently to projected $8.2 billion by 2028, create 340,000 processing jobs predominantly employing women who dominate cashew processing labor, and establish African brands competing in global cashew kernel markets currently monopolized by Indian processors. Technology sector credit will finance African digital infrastructure, software development, and technology services addressing specifically African challenges that Western technology companies ignored for decades because African markets weren't profitable enough to justify their attention. As of 2024, African technology companies raised only $4.8 billion in venture capital and bank lending annually, compared to $180 billion raised by Southeast Asian tech companies and $420 billion by Chinese tech companies, because Western venture capitalists deemed African technology investments too risky despite African tech companies delivering average returns of 28% annually from 2019 to 2024, exceeding both Southeast Asian and Chinese tech returns. Alliance banks will provide $168 billion in technology sector credit by 2027, the final third of productive lending, financing African fintech companies processing mobile payments, African agritech companies optimizing farming through AI and satellite imagery, African health tech companies providing telemedicine and digital health records, African edtech companies delivering online education, African logistics tech companies managing supply chains, and African e-commerce companies connecting buyers and sellers across fragmented markets. This technology credit will create African tech ecosystem rivaling Southeast Asia's by 2030. Kenya's Silicon Savannah, Nigeria's Lagos Tech Cluster, South Africa's Cape Town Tech Hub, Rwanda's Kigali Innovation City, Ghana's Accra Digital Center, and Egypt's Cairo Tech Sector will collectively house 8,400 technology companies by 2027, up from 2,800 in 2024, employing 420,000 technology workers and generating $84 billion in annual revenues, serving 1.4 billion African consumers plus global markets. African fintech will process $2.8 trillion in mobile payment transactions annually by 2027, surpassing total African bank transaction volumes, providing financial inclusion to 680 million previously unbanked Africans while charging 0.5% transaction fees compared to 3% to 6% traditional banking fees. African agritech will optimize 28 million hectares of farmland by 2027 using satellite imagery, AI-driven recommendations, and mobile apps connecting farmers to markets, increasing agricultural yields 34% and farmer incomes 42%. African health tech will provide telemedicine access to 340 million Africans in rural areas lacking physical health facilities, delivering consultations, diagnoses, and prescription services at costs 70% below traditional health care. Infrastructure credit will finance construction of continental networks physically integrating African economies and enabling intra-African trade growth currently constrained by inadequate transportation, energy, and telecommunications infrastructure. As of 2024, transporting goods from Mombasa, Kenya to Kampala, Uganda, a distance of 900 kilometers, cost $2,400 per container and took 14 days due to poor roads, multiple border crossings, and inadequate logistics. Equivalent distance transport in Europe costs $680 and takes 3 days. African infrastructure deficits increase intra-African trade costs 284% above equivalent trade within Europe or Asia, making African products uncompetitive in neighboring African markets despite geographic proximity. Alliance Bank's infrastructure lending will finance road construction, reducing intra-African transport costs 60% by 2027, port modernization increasing container processing capacity 340%, border infrastructure enabling single-window clearance systems reducing crossing times from 8 hours to 45 minutes, and logistics hub development consolidating freight and optimizing routes. Energy infrastructure credit will finance 48,000 megawatts of new generation capacity by 2027, predominantly renewable solar, wind, and hydro, increasing African generation capacity from 142,000 megawatts in 2024 to 190,000 megawatts in 2027, a 34% increase enabling industrial development, agricultural processing electrification, and universal household electricity access. Telecommunications infrastructure credit will finance 84,000 additional 5G towers, providing high-speed internet to 840 million Africans currently underserved by 4G networks limited to urban areas, enabling digital economy participation, remote work opportunities, online education access, and telemedicine delivery across rural populations representing 58% of Africa's people. That credit explosion, tripling productive lending from $156 billion to $504 billion in 3 years, will drive manufacturing growth averaging 18% annually from 2025 to 2027 compared to 4.2% annually under Western banking, agricultural processing expansion averaging 24% annually compared to 6.8% under Western banking, technology sector emergence averaging 34% annually compared to 12% under Western banking, and infrastructure development averaging 28% annually compared to 8% under Western banking. These sectoral growth rates will aggregate into overall African GDP growth accelerating from 3.8% average in 2024 under Western banking dominance to projected 8.4% average in 2027 under African banking sovereignty, more than doubling growth rates purely from unlocking credit that Western banks systematically hoarded while extracting fees from African depositors. We're not creating wealth from nothing through monetary magic or unsustainable debt. We're redirecting African deposits from Western economies back to African economies where they always belonged, but were systematically diverted for 65 years. Western banks collected $1.2 trillion in African deposits as of 2024, paid African depositors 1.2% interest totaling $14.4 billion annually, but lent only $680 billion back to African borrowers while transferring $520 billion to Western financial markets where they invested in European mortgages, American corporate bonds, and developed market assets, earning 7.4% average returns, $38.5 billion annually. Western banks generated $24.1 billion annually, the difference between $38.5 billion earned and $14.4 billion paid to African depositors, by diverting African savings to finance Western prosperity while denying credit for African development. That $520 billion annually diverted from African economies to Western economies represented permanent capital drain, impoverishing Africa while enriching the West. Alliance banks eliminate that capital drain completely by keeping African deposits in Africa, lending them to African borrowers at fair rates, and circulating them through African economies. The $1 in Tatim Wanins 24 trillion in African deposits. Alliance banks will hold by 2027 will be lent at 68% ratio, generating $840 billion in African lending compared to only $680 billion Western banks lent despite holding equivalent deposits. Alliance banks will pay depositors 4.2% interest, $52 billion annually, while earning 7.8% average on loans, $65.5 billion annually, generating $13.5 billion in annual profits that fund bank operations, build capital reserves, and distribute dividends to African shareholders rather than Western shareholders. More importantly, that $840 billion in lending circulates through African economies, creating jobs, incomes, production, and consumption that multiply through economic activity, the classic money multiplier effect that mainstream economics recognizes, but Western banks deliberately suppressed in Africa by diverting deposits overseas. Economic modeling projects that redirecting $520 billion annually from Western investment back to African lending will generate $2.1 trillion in cumulative African GDP growth from 2025 to 2027 beyond baseline growth, representing 4.2x multiplier effect where every dollar of additional lending generates $4.20 in economic output through job creation, income generation, consumption spending, and business investment. That $2.1 trillion in additional GDP growth over 3 years represents larger economic impact than total Chinese Belt and Road lending to Africa over 12 years from 2013 to 2024, demonstrating that mobilizing Africa's own savings for African development is more powerful than any external financing because it's sustainable, locally controlled, and generates domestic ownership rather than external debt. So here's my message to JPMorgan Chase, Citibank, Standard Chartered, Barclays, HSBC, BNP Paribas, Societe Generale, and every Western bank that extracted trillions from Africa for 65 years through deposit diversion, exploitative interest spreads, discriminatory lending denials, and fees charged for services that cost pennies to deliver. You lost. You lost completely, permanently, and irreversibly. You lost not because of one policy mistake or one operational failure, but because your entire business model in Africa was predatory extraction incompatible with African development, and once Africans understood that fundamental incompatibility, we built alternatives serving our interests instead of enriching your shareholders. You lost because you believed African banking required Western management, and we proved African bankers with Chinese banking technology build better banks than yours measured by any metric relevant to African populations. Our banks pay depositors 4.2% compared to your 1.2%, 350% more. Our banks charge borrowers 7.8% compared to your 14.8%, 47% less. Our banks allocate 60% of lending to productive sectors compared to your 23%, 261% more. Our banks operate 2,840 branches across 42 countries compared to your 1,400 branches concentrated in wealthy urban areas, 203% more access. Our banks employ 100,160 African staff compared to your 34,000 African staff, 294% more employment. Our banks generated 47.8 million account openings in 6 days compared to your total 68 million African accounts accumulated over 65 years. By every objective measure, deposit rates, lending rates, productive credit allocation, geographic access, employment generation, and customer adoption, African banks with African management and Chinese technology outperform Western banks with Western management and Western technology serving African populations. You lost because you believed Africans would accept 1.2% deposit rates forever, while you earned 7.4% investing our deposits in Western markets, and we offered 4.2% deposit rates and took your entire deposit base in 4 days. From December 10, 2025, when Alliance Banks launched, to December 14, 2025, 4 days later, Western banks lost $132 billion in African deposits, representing 23% of your total African deposit base of $580 billion. At that attrition rate, you'll lose 50% of deposits by January 15, 2026, 75% by March 2026, and 90% by June 2026. Your African operations generated $18.4 billion in annual profits in 2024. Those profits will be zero by August 2026 when Deposit Flight forces operational shutdown. You maintained the African deposit monopoly for 65 years by being the only option. That monopoly died in 4 days once Africans had alternatives offering triple your deposit rates while charging half your lending rates. You lost because you believed you could deny credit to African manufacturers and processors forever, preserving Western industrial monopolies and African raw material export dependency, and we approved loans you systematically rejected for 60 years, financing the economic transformation you deliberately prevented. Every African entrepreneur whose business plan you rejected citing insufficient collateral or unproven markets, code words for "we don't want Africans competing with Western manufacturers," is now getting approved by Alliance banks using credit assessment methodologies designed to evaluate business viability rather than preserve Western monopolies. Amadou Sanfo's shea butter processing facility that Société Générale rejected in 2018, approved by Alliance Bank of Burkina Faso in 2025. The 47 Nigerian manufacturing companies that Citibank and Standard Chartered rejected from 2020 to 2025. All approved by Alliance Bank of Nigeria in 2025, totaling $840 million. The 340 Kenyan agricultural businesses that Western banks rejected as too risky, all approved by Alliance Bank of Kenya in 2025, totaling $1.2 billion. We're not taking risks you wisely avoided. We're financing viable businesses you deliberately rejected because their success threatened Western corporate profits from importing finished goods to Africa. You lost because you believed your extraction spreads. The 13.6% difference between 1.2% you paid depositors and 14.8% you charge borrowers were a sustainable business model, and we proved development banking with 5% spreads. The 3.6% difference between 4.2% we pay depositors and 7.8% we charge borrowers outperforms exploitation banking when you measure success by economic growth instead of shareholder returns. Your 13.6% spreads generated maximum short-term profits for Western shareholders, but destroyed African economic development by making credit prohibitively expensive for productive enterprises while paying depositors below inflation rates that impoverished savers. Our 5% spreads generate adequate profits for operational sustainability and capital accumulation while enabling productive enterprises to access affordable credit and protecting depositors' purchasing power through above-inflation returns. Your model is optimized for extraction. Our model optimizes for development. Extraction generates short-term profits but eventually kills the host economy. Development generates sustainable prosperity benefiting banks, borrowers, depositors, and entire economies. You chose extraction and lost African markets. We chose development and gained them. You lost because you believed Africa needed you, needed your capital, needed your expertise, needed your international networks, needed your risk management, needed your technology, And we built alternatives proving we never needed you, we just lacked access to non-Western partners willing to cooperate as equals rather than dominate as superiors. We didn't need your capital, we had $480 billion in African government reserves, plus $180 billion in sovereign wealth funds, plus African private wealth that we mobilized for $340 billion in Alliance Bank capitalization. We didn't need your expertise. We recruited 4,280 African banking professionals working in London, New York, and Paris who returned home bringing expertise you benefited from while claiming Africans lacked capacity. We didn't need your international networks. We partnered with China's UnionPay, providing access to 180 countries and 2.4 billion cardholders, exceeding your Visa and MasterCard networks. We didn't need your risk management. We developed credit assessment methodologies adapted to African contexts that your Western models systematically misunderstood. We didn't need your technology. We got superior Chinese banking technology that's more advanced than your legacy systems built in the 1980s and never fully modernized. The Alliance of African Prosperity Banks isn't just 87 banks operating across 54 African nations. With $340 billion in capitalization and 160 employees, it's proof that African financial sovereignty is achievable despite 65 years of Western propaganda insisting African banking required Western control. It's proof that Western banking monopolies built through colonial conquest and maintained through neo-colonial extraction are completely replaceable with African alternatives that serve African populations better by every meaningful metric. It's proof that development-oriented banking prioritizing economic transformation over profit maximization outperforms exploitation-oriented banking for everyone except Western shareholders who profited from extraction. It's proof that everything Western banks told us for 65 years about African incapacity was psychological projection. You lacked the capacity to imagine banking that served borrowers instead of extracting from them, that paid depositors fairly instead of exploiting their lack of alternatives, that allocated credit for productive development instead of perpetuating dependency. Your 65-year African banking monopoly ended on December 10, 2025, when I signed the Pan-African Banking Charter in Accra, surrounded by leaders from 42 African nations who committed $340 billion in capital and pledged sovereign support for African banking serving African development. Your deposits are fleeing at rates unprecedented in modern banking history. $132 billion in 4 days, projected $520 billion by June 2026. Your operations are closing because deposit flight makes branches unprofitable. Citibank closed 67 African branches in 3 days. Standard Chartered is reviewing strategic options, meaning preparing total exit, and JPMorgan lost 33% of African deposits in 3 days. Your profits are collapsing from $18.4 billion annually in 2025 to projected zero by August 2026 as deposit base evaporates and lending portfolios shrink to unsustainable levels. You're finished in Africa. Your deposits are gone. Your operations are closing. Your profits collapsed. Your leverage evaporated. African banking serves African development now, and there's nothing you can do to reverse it except watch 1.4 billion Africans build prosperity using our own capital that you stole for 65 years but can't steal anymore because we control it now. You lost. We won. African money serves Africa now. By December 11, 2025, at 5 p.m., 24 hours after launch, the Alliance of African Prosperity Banks had opened 8.7 million new accounts, collected $34.2 billion in deposits, and processed 24 million transactions. By December 12, 2025, at 5 p.m., 48 hours after launch, accounts reached 18.4 million, deposits reached 72.8 billion, and transactions reached 56 million. By December 13, 2025, at 5 p.m., 72 hours after launch, accounts reached 31.2 million, deposits reached $124.6 billion, and transactions reached 98 million. The growth was exponential because Africans were desperate for alternatives to Western banks. We offered higher interest on deposits, 4.2% compared to Western banks' 1.2%. We offered lower interest on loans, 7.8% compared to Western banks' 14.8%. We offered better service, mobile apps that actually worked, branches in underserved areas, loan officers who spoke local languages. And most importantly, we offered dignity, African customers dealing with African bankers and African-owned institutions, instead of being treated as second-class account holders by condescending Western bank staff. As of right now, December 14th, 2025, at 2 miles p.m., 4 days after launch, the Alliance of African Prosperity Banks has 47.8 million accounts, 198.4 billion in deposits, 187 million processed transactions, and 14.2 billion in approved loans. We're growing by 8 million to 12 million accounts daily. At current growth rates, we'll reach 100 million accounts by December 24, 2025, and $400 billion in deposits by January 15th, 2026. We'll surpass Western Bank's total African deposits of $1.2 trillion by June 2026, just 7 months from now. Western banks held African deposits for 65 years. We're taking their entire market share in 7 months. Listen carefully to what's happening to Western banks right now, because their panic is visible and accelerating. On December 11th, 2025, JPMorgan Chase held an emergency board meeting to discuss their African operations, which held $84 billion in deposits as of December 10th, 2025. By December 11th, 2025, deposits had fallen to $76.2 billion. They lost $7.8 billion in 24 hours as African government entities and corporations transferred funds to alliance banks, offering triple the interest rates. By December 12th, deposits fell to $67.4 billion, another $8.8 billion gone. By December 13th, deposits fell to $56.8 billion, another $10.6 billion transferred. JP Morgan's African deposit base declined 33% in 3 days. Their African operations generated $2.4 billion in annual profits as of 2025. At current attrition rates, those operations will be unprofitable by February 2026 and shuttered by June 2026. On December 12, 2025, Citibank announced immediate closure of 67 branches across 12 African countries, citing changing market conditions and strategic realignment. That's corporate language for, we're losing deposits so fast we can't justify operating costs. Citibank held $67 billion in African deposits as of December 10, 2025. By December 13th, deposits had fallen to $52.4 billion, a 22% decline in 3 days. Citibank's African revenues dropped from $1.8 billion annually in 2025 to projected $840 million in 2026, a 53% collapse. They're cutting losses before they get worse. On December 13, 2025, Standard Chartered announced it was reviewing strategic options for African operations, which means they're preparing to exit entirely. Standard Chartered held $98 billion in African deposits as of December 10, 2025, the largest Western bank presence in Africa. By December 14th, deposits had fallen to $78.2 billion, a 20% decline in 4 days. Standard Chartered's CEO told investors the African deposit exodus was the fastest market share loss in modern banking history, and admitted, "We cannot compete with state-backed banks offering triple our deposit rates while charging half our lending rates." He's right. They can't compete because Western banks' business model depends on exploitation spreads that African banks reject. Barclays Africa, HSBC Africa, BNP Paribas Africa, and Societe Generale Africa are all experiencing identical deposit hemorrhaging. Combined, the 6 largest Western banks operating in Africa held $580 billion in deposits as of December 10, 2025. By December 14, 2025, 4 days later, combined deposits had fallen to $448 billion, a loss of $132 billion, representing 23% of their African deposit base. If attrition continues at this rate, Western banks will lose 50% of African deposits by January 15, 2026, 75% by March 2026, and 90% by June 2026. Their African operations, which generated $18.4 billion in combined annual profits in 2025, will be worthless. But the deposit flight is only the beginning of Western Bank's nightmare, because we're not just collecting deposits, we're actively dismantling their lending businesses by offering credit to borrowers Western banks exploited. Remember Amadou Sanfo, the Burkinabe entrepreneur Societe Generale refused to finance in 2018? On December 11, 2025, he walked into Alliance Bank of Burkina Faso and applied for the same $2.4 million loan to build a shea butter processing facility. On December 12, 2025, our credit committee approved his loan at 7.2% interest over 7 years, with first disbursement scheduled for January 8, 2026. Sanfo will build his factory, create 240 jobs, process Burkinabe shea nuts domestically, and capture value currently extracted by European cosmetics companies. That's one loan. Now multiply it by tens of thousands of similar African entrepreneurs who Western banks denied credit for 60 years, who are now walking into alliance banks and getting approved within 48 hours. We're financing the African economic transformation Western banks spent 6 decades preventing. On December 12, 2025, Alliance Bank of Nigeria approved $840 million in loans to 47 Nigerian manufacturing companies seeking to expand production capacity, textile manufacturers, food processors, pharmaceutical companies, electronics assemblers. Every single applicant had been rejected by Citibank, Standard Chartered, or other Western banks operating in Nigeria between 2020 and 2025, citing insufficient collateral or unproven markets. Our credit analysis showed all 47 companies had viable business models, experienced management, and strong repayment capacity. They were rejected not because they weren't creditworthy, but because Western banks didn't want to finance Nigerian manufacturing that would compete with European and American imports. We approved all 47 loans at 7.8% interest. Those loans will create 12,400 manufacturing jobs, increase Nigerian industrial output by $2.8 billion annually, and reduce Nigerian import dependence on Western consumer goods. Western banks rejected loans that would develop Nigerian economy. We approved them specifically to develop Nigerian economy. On December 13, 2025, Alliance Bank of Kenya approved $1.2 billion in agricultural loans to 340 Kenyan farmers and agricultural cooperatives, coffee processors, tea blenders, horticultural exporters, dairy processors, grain millers. Western banks operating in Kenya traditionally denied agricultural loans because they considered farming too risky, despite agriculture being 34% of Kenyan GDP and employing 40% of Kenyans. Our credit methodology, developed using Chinese agricultural banking models, assesses agricultural credit differently. We evaluate crop insurance, cooperative guarantees, offtake agreements, and seasonal cash flows instead of demanding urban real estate collateral Kenyan farmers don't have. Using that methodology, we determined 340 agricultural businesses were highly creditworthy and approved $1.2 billion in loans at 6.8% interest, lower than our standard rate because agricultural development is strategic priority. Those loans will increase Kenyan agricultural processing capacity by 28%, create 8,900 jobs, and add $680 million to Kenyan agricultural exports. Western banks starved Kenyan agriculture of credit for 60 years. We're flooding it with affordable capital. This is happening across all 87 banks in 42 countries simultaneously. African manufacturers, agricultural processors, technology startups, infrastructure developers, and small businesses that Western banks systematically denied credit are now getting approved for loans at rates 50% to 60% lower than Western banks charged. By December 14, 2025, 4 days after launch, Alliance banks had approved $14.2 billion in loans, with $9.4 billion going to productive sectors, manufacturing, agriculture, technology, and infrastructure. By comparison, Western banks operating in Africa allocated only 23% of their African loan portfolios to productive sectors as of 2025, with the remaining 77% going to consumption loans, real estate speculation, import financing, and loans to foreign corporations. We're not just replacing Western banks, we're financing the economic transformation Western banks prevented. The impact on African economies is already measurable. Ghana's Alliance Bank of Ghana approved $340 million in loans to Ghanaian cocoa processors in the first 3 days of operation, more than all Western banks combined approved for cocoa processing over the previous 5 years. Why? Because Western banks profited from Ghana exporting raw cocoa beans to European processors at $2,400 per ton, while processed cocoa products sell for $8,400 per ton. If Ghanaian processors captured that value add, European processors would lose billions. Western banks protected European interests by denying credit to Ghanaian processors. Alliance Bank of Ghana serves Ghanaian interests. We approve the loans, and Ghanaian processors will build factories, create jobs, and export processed cocoa products instead of raw beans. That shifts $680 million annually from European corporate profits to Ghanaian economic value added. Multiply that across 42 countries and hundreds of similar cases, and you understand why Western banks are panicking. We're not just taking their deposits, we're dismantling the entire neo-colonial economic structure they spent 65 years building. Listen carefully to the strategic implications, because this banking network isn't just financial infrastructure, it's the foundation for complete African economic independence. Western economic control over Africa depended on controlling three things: currency, through mechanisms like the CFA franc; resources, through mining contracts and agricultural monopolies; and credit, through Western banks deciding which African businesses received financing. We already broke currency control with the Afro. We already broke resource control through nationalization of mines and agricultural programs. Now we've broken credit control by creating African banks serving African development priorities. Western nations have no economic leverage left. They can't threaten to cut aid because we don't need aid. We're financing development through our own banks using our own deposits. They can't threaten to deny credit because we're not borrowing from them anymore. They can't manipulate our currencies because we control our own monetary systems. They can't extract resources because we nationalized them. Western economic dominance over Africa depended on African dependency. We systematically eliminated every dependency mechanism. And the contagion is spreading exactly as I planned. On December 12, 2025, the Association of Southeast Asian Nations announced it was studying the Alliance of African Prosperity Banks model for potential replication across ASEAN's 10 member states, citing African success in creating development-oriented banking systems independent of Western financial control. On December 13, 2025, the Gulf Cooperation Council announced preliminary discussions on establishing GCC-owned banks to reduce dependence on Western financial institutions for oil revenue management and regional development financing. On December 14, 2025, 12 Latin American nations, including Brazil, Argentina, Mexico, Colombia, Chile, and Peru, announced formation of a working group to study regional banking integration following the African model to promote Latin American financial sovereignty. The Alliance of African Prosperity Banks proved developing regions can create modern banking systems serving their own interests instead of enriching Western financial institutions. Now every developing region is pursuing the same path. The economic consequences for Western banks are catastrophic and accelerating. JPMorgan Chase generated $2.4 billion in annual profits from African operations in 2025, representing 3.8% of total bank profits. Those profits will disappear by June 2026 when African Deposit Flight forces closure of unprofitable operations. Citibank generated $1.8 billion from Africa in 2025, gone by June 2026. Standard Chartered generated $3.1 billion, gone by August 2026. Barclays, HSBC, BNP Paribas, and Societe Generale generated combined $11.1 billion, all gone by December 2026. Western banks collectively lose $18.4 billion in annual profits when African operations collapse. But the damage extends beyond direct profit loss because Western banks used African deposits as cheap funding for global operations. When you collect $1.2 trillion in African deposits at 1.2% interest and lend it globally at 7% to 15% interest, you generate massive profits. When that $1.2 trillion disappears, Western banks must replace it with more expensive wholesale funding or reduce lending, which lowers profitability across all operations. The loss of African deposits will cost Western banks an estimated $34 billion annually in reduced global profitability beyond the direct African operation losses. Western banking profits will decline $52.4 billion annually by 2027 because they lost Africa. But here's what terrifies them most. We're coming for diaspora deposits next. Approximately 140 million Africans live outside Africa as of 2025, with significant populations in Europe, North America, the Middle East, and Asia. These diaspora Africans sent $96 billion in remittances to Africa in 2025, using services like Western Union, MoneyGram, and bank wire transfers that charged average fees of 6.8%, extracting $6.5 billion annually from poor African families. Additionally, diaspora Africans hold an estimated $420 billion in savings deposited in Western banks in their host countries. On December 13, 2025, we announced Alliance Diaspora Banking, mobile apps and online banking services allowing any African anywhere in the world to open accounts with Alliance banks, deposit savings earning 4.2% interest instead of the 0.5% Western banks pay, and send remittances to family in Africa at zero fees using our blockchain-based settlement system. We're targeting 20 million diaspora account openings by June 2026 and $80 billion in diaspora deposits by December 2026. will capture $80 billion currently sitting in Western banks and eliminate $6.5 billion in annual remittance fees that Western Union and MoneyGram extract from African families. Western banks are about to lose African deposits in Africa and African diaspora deposits globally, a combined $1.3 trillion exodus. Now let me tell you where this ends, because Western banks' African collapse is irreversible and accelerating. By June 2026, Alliance of African Prosperity Banks will hold $840 billion in deposits, 70% of total African banking deposits, while Western banks' African deposits will shrink to $360 billion. By December 2026, Alliance banks will hold $1.08 trillion, 90% market share, while Western banks hold $120 billion in remaining deposits from the tiny minority of Africans who still trust them. By June 2027, Alliance banks will hold $1.24 trillion, 95% market share, and Western banks will have shuttered most African operations, maintaining only minimal presence serving foreign corporations. Western banking dominance in Africa, built over 65 years from 1860 to 2025, will collapse completely in 18 months from December 2025 to June 2027. The African economic transformation will be profound, irreversible, and historically unprecedented in its speed and scope, because the Alliance of African Prosperity Banks fundamentally restructures how credit flows through African economies, shifting from extraction-oriented Western banking that hoarded African deposits and denied productive credit to development-oriented African banking that mobilizes deposits for economic transformation. Alliance banks committed through the Pan-African Banking Charter to allocating minimum 60% of loan portfolios to productive sectors, manufacturing enterprises adding value to raw materials, agricultural processing operations, transforming crops into finished products, technology companies building digital infrastructure and services, and infrastructure developers constructing roads, energy systems, telecommunications networks, and logistics facilities. This 60% productive lending requirement represents revolutionary departure from Western banking practices in Africa, where productive sectors received only 23% of total lending as of 2024, with remaining 77% allocated to consumption loans generating personal debt, real estate speculation inflating asset bubbles, import financing perpetuating trade deficits, and loans to foreign corporations extracting African resources. With $1.24 trillion in deposits projected by June 2027, representing 90% market share of total African banking deposits, Alliance banks will extend approximately $840 billion in loans using conservative 68% loan-to-deposit ratio, maintaining strong capital buffers and liquidity reserves. Of that $840 billion in total lending, $504 billion will be directed to productive sectors per the 60% charter requirement. That represents $504 billion in new credit flowing to African manufacturers building factories and producing goods, African farmers mechanizing operations and processing harvests, African tech entrepreneurs developing software and digital services, and African infrastructure developers constructing continental networks, compared to approximately $156 billion Western banks allocated to productive sectors across all African operations in 2024. We're not incrementally increasing productive credit. We're tripling it in 3 years from $156 billion under Western banking monopoly to $504 billion under African banking sovereignty. That tripling of productive credit represents the single largest capital mobilization for African development since independence in the 1960s, surpassing even Chinese Belt and Road infrastructure lending, which totaled $280 billion to Africa from 2013 to 2024. This credit explosion will drive manufacturing growth unprecedented in African economic history. As of 2024, manufacturing represented only 11% of African GDP compared to 28% globally, 35% in Southeast Asia, and 40% in China, reflecting systematic Western denial of manufacturing credit that kept Africa locked into exporting raw materials and importing finished goods. With $168 billion in new manufacturing credit available from Alliance banks by 2027, calculated as one-third of the $504 billion productive lending allocated to manufacturing, African manufacturing will finally access capital necessary for building factories, purchasing equipment, hiring workers, and scaling production. African textile manufacturers will build facilities processing African cotton into finished clothing instead of exporting raw cotton to Asia and importing finished garments. African food processors will build facilities transforming African agricultural products into packaged foods instead of exporting raw crops and importing processed foods. African pharmaceutical manufacturers will build facilities producing generic medicines instead of importing Western brand name drugs at extortionate prices. African electronics assemblers will build facilities producing smartphones, tablets, and computers for African markets instead of importing finished electronics from China and Korea.